My dear children, my beautiful friends, as someone who has spent more than 50 years in the markets, I strongly advise you to listen carefully to what I am about to tell you today. Right now, all of you are sitting at a giant gambling table without realizing it. And nobody is telling you the rules of this table, how the game is played, in a straightforward and honest way. Today, I will first take you back to what happened in France in 1720 and tell you about that process. Because history repeats itself and exactly the same thing is happening right now. Only the clothes and the setting have changed. There was a man named John Law. He was Scottish, but he trusted himself so much that he convinced the Kingdom of France and began managing the country's central bank. France was bankrupt at the time. 5 decades of wars had depleted the treasury, and the state was crushed under an enormous debt burden. Law came and said, "Give me permission. Let me print paper money backed by the future profits to be obtained from France's territories in America, and I will solve this debt problem." The desperate French government agreed, and Law founded the Mississippi Company, which supposedly owned all those valuable lands in Louisiana. He issued shares, and people bought these shares because it was nice not to have to carry gold, and everyone was getting rich on paper. The share price rose from 500 livres to 18,000 livres in less than 2 years. Everyone in Paris was selling their properties, their jewelry, everything they had, trying to buy more shares. They were setting up tents in front of Law's house, trampling each other to get a share of the next public offering. But here was the real issue. The Louisiana Territory was basically worthless swampland. There was no gold, no profitable trade, nothing generating real income. Law was just printing money and using new investments to pay returns to early investors. But things got even worse. Law knew this was unsustainable, so he started printing even more money to buy the debt himself, inflating both the currency and the stock. The French government loved this because their debts seemed to be disappearing, so they gave him more power. Then in 1720, people started asking questions. They wanted to convert their paper shares into gold. Law didn't have the gold. Within 6 months, shares dropped from 18,000 livres to 500, then to 0. Those who had been millionaires on paper went bankrupt. The French economy collapsed so hard that paper money was banned for decades. Law fled the country and died penniless in Venice 9 years later. So who won? The French government got off by loading mountains of debt onto private investors. A handful of people who knew how things would turn out left as wealthy individuals. Who lost? Almost everyone in France. Middle-class families, small business owners, people who believed the system would protect them. And the most painful part, the bankers and government officials who made law possible faced almost no consequences. They simply moved on to the next game. Now I want to ask you this: what does this have to do with investing in 2026? Almost all of you are thinking to yourselves that it has nothing to do with it, but actually everything is related. Because right now you are being sold the same concentrated bet. Only instead of the Louisiana swampland, this time there are companies. My dear children, imagine you are building a house and the contractor says we will use the best materials. Sounds great, doesn't it? Then you find out that 70% of your house, the foundation, the walls, the roof, all of it rests on 7 wooden beams. These beams are really strong right now, the strongest beams on the market. But you're thinking, what happens if 3 of these beams crack? The contractor says, don't worry, these beams have been getting stronger every year for 15 years. Would you live in that house? Would you raise your children there? Because that is exactly what your portfolio is. As of early 2026, the S&P 500 index, the thing every financial advisor tells you to buy and hold forever, has concentrated more than 30% of its total value in 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. Just 7 out of 500 companies, holding nearly a third of the weight. In the 90s, the top 7 companies made up maybe 15%. We have doubled the concentration in 25 years, and everyone treats this as normal. Now you might be thinking, okay, but these companies are massive and profitable. They are literally printing money. That is true, but so did the Nifty 50. My dear children, let me tell you about the Nifty 50 of the early 70s. These were the 50 stocks that every institutional investor said buy and never sell. Large American companies like Polaroid, Xerox, Kodak, Avon, Sears. The idea was that these companies were so dominant, so well managed, so essential to American life that you just buy without even looking at the price and hold forever. Growth was guaranteed. These stocks were trading at 50, 60, 80 times earnings ratios. But people said it didn't matter because growth would catch up at some point. Then 1973 came. Oil crisis. Inflation spiked. Recession hit. Suddenly, growth stocks were not growing. The Nifty 50 crashed. Polaroid fell 91% from peak to trough. Avon fell 86%. Xerox fell 71%. These were not speculative companies, these were the safest companies in America. And if you bought at the peak in 1972, getting back to where you bought, without counting inflation, took about 25 years for some of them. A quarter century of zero returns on the safest investments. Let me tell you, step by step, what happened. First, institutional investors decided that a small group of stocks were so good that valuation didn't matter. Then they poured money into those stocks and drove prices upward. Then the high prices became evidence of quality and created a feedback loop. Then, when economic conditions changed, those overvalued stocks had a very long way to fall. And finally, the diversification everyone thought they had disappeared because all the safe stocks crashed together. The financial sector learned nothing from this situation. It just waited 20 years and did the same thing with technology stocks in the late 90s, then did it again with housing in 2007, and is now doing it again with mega-cap tech in 2026. So what does this pattern look like today? Let's talk about Nvidia, an incredible company, genuinely revolutionary technology. I'm not saying they're bad, but in 2023, Nvidia was worth around $300 billion. By early 2026, it crossed $3 trillion. That's a 10 times increase in under 3 years. Its revenues grew, sure, but not 10 times. What grew 10 times was the multiple investors were willing to pay. The exact same thing that happened to Polaroid in 1972. The real issue is that your index fund is now massively dependent on Nvidia staying at that valuation or going higher. If Nvidia drops 50%, that alone takes almost 5% off the S&P 500. Add in similar drops for Apple, Microsoft, and a couple of other companies, and you're down 20 to 30%, even if the other 493 companies do fine. This is where things get really interesting. The system is designed to hide this risk from you. How? First, they call it diversification. You own an index fund with 500 companies. That sounds diversified. But if 7 of those companies make up a third of your money, you're not diversified, you're concentrated. This is a linguistic trick. Second, they use market cap weighting. Its only meaning is this: the stocks that have already gone up the most get the biggest share of new money. You're automatically buying more of what's expensive and less of what's cheap. This is the exact opposite of what every successful investor should do. Third, they show you long-term charts that smooth out the crashes. Yes, the market always recovers eventually, but eventually might be 25 years, and maybe you don't have 25 years. My dear children, let me give you the emotional reframe you need. You are not a passenger in this system, you are the product. The financial sector makes money from fees and volume, not from returns. When they say buy and hold index funds, what they mean is give us your money for 30 years, and don't ask questions while we collect our percentage, regardless of what happens. Don't ask for the money back. I'm not saying index funds are bad. I'm saying that blind index investing in 2026 is playing a game where the rules are rigged against you. So, if I had money and was starting from scratch, knowing how markets really work, what exactly would I do? As the first step, I would check my actual current exposure. Not what I think I'm exposed to, what I'm actually exposed to. If you own an S&P 500 index fund or a total market fund, go look up the top 10 companies, add up the percentages. If it's more than 25% in the top 10, you're concentrated, not diversified. Most people have never done this, they just assume that index fund equals safe harbor. Go look tonight, Vanguard, Fidelity, Schwab, whichever you use. Look for 5 minutes and do your research. As the second step, I would implement what I call an inverse concentration strategy. Instead of letting market cap weighting automatically put 30% of my money into 7 stocks, I would manually create a position that does the opposite. You can buy equal weight index funds where all 500 companies get the same allocation regardless of size. Or you can buy international developed markets, which are currently trading at 15-year low valuations compared to US stocks. Or you can buy small and mid-cap value stocks, which have historically outperformed large cap growth over 20-year periods, but have been left behind for the last decade. I'm not saying sell everything and invest in small cap stocks. I'm saying if the market is automatically concentrating your risk in 7 companies, you need to manually rebalance that risk somewhere else. If 30% of a standard index is in mega cap tech, maybe 30% of your portfolio goes into things that are negatively correlated or at least uncorrelated. Emerging markets, commodities, real estate investment trusts that actually own physical property, and Treasury inflation-protected securities if you're worried about inflation coming back. The math goes like this. Let's say you have $500,000 in a standard S&P 500 fund. About $150,000 of that is in the big 7 tech stocks. If those stocks drop 50% over the next 2 years, you just lost $75,000 from that concentration alone. The other $350,000 might stay flat or drop less, but you're still down 15% overall just from 7 stocks. Now imagine you had rebalanced 6 months ago. You moved 75,000 of that 150,000 into equal weight or international or small cap value. Those alternatives might also drop, but they won't drop 50% because they're not as overvalued. Maybe they drop 20%. Now you've lost 15,000 instead of 75,000. That's $60,000 of protection just from recognizing the concentration risk. But now you might be thinking, what if those 7 stocks keep going up? What if Nvidia hits 5 trillion and I miss out? Here's the thing, you have to decide what you're optimizing for. Are you trying to maximize your upside, assuming the current trend continues forever? Or are you trying to build actual wealth that survives different market conditions? Because nobody can know when the music stops. John Law's Mississippi Company looked like a sure thing until it didn't. The Nifty 50 looked unstoppable until they stopped. Housing prices only go up until they go down. Rather than taking the risk of going full speed and losing everything, I prefer to take 70% of the gains in a bull market and avoid 70% of the losses in a bear market. This is not being scared, this is being smart. The people who got rich and stayed rich are the ones who didn't blow up. As the third step, I would set up what I call valuation alarm mechanisms. These are automatic rules that force me to rebalance when things get crazy, because at that moment, you won't want to rebalance. In 1999, people who sold technology stocks looked stupid for 2 years. Then they looked like geniuses. You need rules that remove emotion. An example rule. If any single stock in my portfolio becomes more than 8% of my total account value, I automatically sell enough to bring it back to 8%. If the S&P 500 price-to-earnings ratio goes above 30, I automatically move 10% of my stock allocation into bonds or cash. If the top 10 companies in my index fund exceed 30% of the total, I rebalance into equal weight. These aren't market timing, these are valuation discipline. You're not trying to predict crashes, you're limiting your exposure to expensive assets and rebalancing into cheaper ones. This is what every successful wealth fund does, but retail investors are told to just buy and never sell. The fourth step, and the thing nobody talks about, I would build an income floor outside the market. The reason people panic sell at the bottom is because they need the money and the market is crashing and they have no other option. If you have 12 months of expenses in a high-yield savings account earning 4 to 5%, and you have some dividend-paying stocks or bonds throwing off even a small amount of income, you can survive a market crash without selling at the bottom. In 2008, people with cash bought stocks at 50% off. People without cash sold at 50% off to pay their mortgage. Same event, opposite outcomes, entirely based on having a buffer. I would not neglect building income streams that aren't tied to my portfolio value either. This could be a side business, rental income from real estate, royalties from something you create, even part-time consulting in your own field. The goal is that if the market cuts your portfolio in half, Your life doesn't fall apart. You're not desperate. Desperation makes you sell low and buy high, which shows how wealth gets transferred from regular people to institutions. The fifth step. I would get really honest about time horizon. The advice to buy and hold for 30 years is great if you're 25. If you're 45 and planning to retire at 60, you don't have 30 years to recover from a crash. You have 15 years. And if a major crash happens in year 10, you're in big trouble. The sequence of returns matters as much as the average return. Two people can get the same average annual return over 20 years. But if one person has a crash right before retirement and the other has it at the beginning of their career, the first person runs out of money and the second person has time to recover. If you're within 10 years of needing the money, you cannot afford to have 30% of your portfolio in 7 perfectly priced stocks. You need to de-risk even if it means lower returns. Because losing 25% when you're 55 is not the same as losing 25% when you're 30. At 30, you have time and income to recover. At 55, that loss might be permanent. My dear children, let me now tell you the big picture. The financial sector spent 40 years convincing you that investing is complicated and you need experts. Then the experts tell you to buy index funds and do nothing. Why? Because it's profitable for them and easy to scale. They're lying by omission when they act like all index funds are the same and concentration risk doesn't exist. Just like John Law convinced France that paper money backed by nothing was the same as gold, the financial sector has convinced you that an index fund with 30% in 7 stocks is the same as diversification. But these are not the same. It's a concentrated bet on the continued dominance of a handful of companies trading at valuations that historically preceded major crashes. Now let me tell you what the smart money is doing. By smart money, I don't mean hedge funds doing crazy derivatives. I mean the Yale Endowment, considered one of the best managed pools of money in the world, and this fund holds less than 10% in US stocks. 10%. The rest is in private equity, real assets, foreign markets, absolute return strategies that don't move in lockstep with the S&P 500. They're not trying to beat the index every single year. They're trying to compound wealth across different economic environments without catastrophic losses. You can't replicate Yale's endowment as a regular person, but you can replicate the philosophy. Diversify across asset classes that don't all crash together. Don't let any single bet become too big. Rebalance from expensive to cheap. Build income sources outside your portfolio. Boring, I know, but boring is what survives. Here is what I would avoid in 2026. I would avoid anything sold as you can't lose, or guaranteed returns, or safe as the market. I would avoid trying to time the market by going to cash and waiting for a crash, because you'll miss years of gains and probably get back in at the wrong time anyway. I would avoid complex products I don't understand like leveraged ETFs, inverse funds, option strategies. If you can't explain how it makes money to a 12-year-old, don't put your savings in it. And I would avoid the temptation to do nothing just because doing something feels overwhelming. Doing nothing right now, when concentration is at historic highs, is an active choice to accept that risk. You're not neutral. You're passive, and there is a world of difference between these two situations. My dear children, let's talk about the psychological shift that needs to happen. Most people treat their portfolio like a plant. Water it with regular contributions, leave it in the sun, check on it once a year, hope it grows. This worked great from 1980 to 2000 and from 2009 to 2021 when we had multi-decade tailwinds of falling interest rates and expanding valuations. But those tailwinds are over. Interest rates are higher and unlikely to go back to zero. Valuations are already at the very top of historical ranges. You can't just put your money somewhere and wait anymore. You have to treat your portfolio like a garden. You still plant and water, but you also weed, you prune, you rotate crops, you adapt to the seasons. That doesn't mean following every headline. It means quarterly check-ins, where you look at valuation, rebalance what's gotten too big, trim what's expensive, add to what's cheap. This is active management in the sense of being engaged, not active trading in the sense of constant buying and selling. Let me explain why this matters emotionally. When the next crash comes, and it will come because crashes always come, you need to know that you did something. If you just bought a standard index fund and tried to forget about it, you're going to feel like a victim when it drops 30 to 40%. You'll panic. You'll sell at the bottom, you'll swear off stocks forever. But if you've already taken steps to reduce concentration, to build an income floor, to diversify across assets, you'll feel like you prepared for the crash. You won't be happy about the losses, but you won't collapse. You'll be able to hold on or even buy more. And that's the difference between people who build wealth through cycles and people who get wrecked. My dear children, let me give you a concrete scenario. It's late 2027. There's been some kind of shock, doesn't matter what. Recession, geopolitical crisis, tech regulation, whatever. Mega-cap tech stocks drop 40% in 6 months. The S&P 500 drops 28% overall. Your coworker who has everything in a standard index fund and was planning to retire in 2028 now has his portfolio go from 900,000 to 650,000. Angry, scared. He sells half of what's left and puts it in cash, locking in the losses. The market recovers over the next 3 years, but he misses most of it because he was in cash. You, on the other hand, rebalanced a year earlier. You moved some money into equal weight, some into international, some into bonds. You kept a cash buffer. Your portfolio drops 20% instead of 28%. Not fun, but you knew this could happen. You don't need the money for 5 more years, and you have a year of expenses in cash, so you don't have to sell. Actually, you take some of that cash and buy stocks at lower prices. 3 years later, when the market recovers, your portfolio is higher than it was before the crash. Same market, different outcome because you prepared. Let me give you one more historical example. In 1989, Japan's stock market was the largest in the world. The Nikkei index hit 38,915. Japanese companies were buying up American real estate. Everyone said Japan would overtake the US economically, and Japanese stocks traded at 60 times earnings because growth was inevitable. If you were a Japanese investor in 1989 and you listened to the experts who said just buy the index and hold, you would have lost 75% over the next 3 years. The Nikkei bottomed around 7,000 in 2003. As of 2026, 37 years later, it only recently got back to the 1989 peak. 37 years of zero real returns. So the lesson we should draw from this event is not don't invest in stocks. The lesson is don't assume that what worked for the last 15 years will work for the next 15. The US market has been the best performing in the world. Mega-cap tech has been the best performing sector. Passive indexing has been the best performing strategy. All of those could reverse, and if they do, the people who were 100% in a cap-weighted US index fund will suffer the most. So what would I actually do in this situation? If I were building a portfolio from scratch in 2026, I would start with this mix. And I want to be clear, this is not financial advice, this is what I would do for myself, knowing my risk tolerance and time horizon. 30% in a diversified US stock fund that's equal weight or tilted towards small and mid-cap value. 20% in international developed markets, meaning places that are cheaper than US stocks right now, like Europe, Japan, Australia. 10% in emerging markets for long-term growth exposure. 15% in real assets, meaning real estate investment trusts and commodities that do well when inflation picks up. 15% in a mix of treasuries for safety and corporate bonds for yield. 10% in cash or short-term equivalents, which are your emergency and opportunity fund. This mix gives you exposure to stocks for growth, international for diversification, real assets for inflation protection, bonds for stability, and cash for flexibility. No single position dominates. If tech crashes, you're not destroyed. If inflation spikes, you have some protection. Would this portfolio beat the S&P 500 if the current concentration trend continues and those 7 stocks double again? No, you'd underperform. Because if the concentration reverses and those 7 stocks crash, you'd outperform by a huge margin. You're trading maximum upside for lower crash risk. And at a certain point in your wealth-building journey, that's the right trade. When you're trying to get your first 100,000, take more risk. When you're trying to protect 500,000 or 1 million, not losing it becomes more important than doubling it. My dear children, in conclusion, let me tell you this. If I wanted to invest in 2026, I would start by admitting that the environment is different than it was in 2010 or even 2020. Valuations are high, concentration is extreme, the easy gains from falling rates are over. I'd check my actual exposure and fix any concentration risk. I'd build a cash buffer so I'm never forced to sell at the bottom. I'd diversify across assets and geographies that won't all crash together. I'd set up rules to rebalance automatically. And I'd accept that I might underperform in the short run if the current trends continue. That's it. Not complicated, not sexy, not going to make me a millionaire in 12 months. But it's real. Designed to survive different outcomes instead of relying on one specific thing to keep happening. Most people won't do this because it requires effort, and it means admitting that the default option might not be the best option. But if you're still listening, you're not most people. You're someone who actually wants to understand this stuff and make smart decisions. Tonight, go to your portfolio and check your situation.